Where is Goldilocks, and has anyone seen her? That's the question the markets are asking as we get toward the end of the week. Welcome. This is Macro Money. I'm Elias Pivak, head of global macro here at tastylive. And we have one last piece of big news to contend with this week, as though what we've seen so far were not enough. But it is an important one, and it is one that might make or break some of the disconnect and some of the conflicting news and conflicting narratives, conflicting price action that we've seen out of these markets in the past, just about over a week or so. So let's take a look here and set the stage. Of course, as ever, the question continues to be focused on the Fed and what we might expect them to do and whether markets like that or not. And of course, the most important input yet to be accounted for in the Fed's calculus is an update on inflation. We just got an update on growth today and yesterday. It's the inflation piece of the Fed's puzzle that now gets a little bit of a re-up. Of course, we've already seen the CPI numbers for December's edition, but now we get the PCE, which is the Fed's favored inflation gauge, and what that might tell us about next steps. We got a little bit of a preview of it in today's fourth quarter GDP report, but that was a quarterly number. And what we're looking at in the next 24 hours will be the year-on-year PCE inflation measure that the Fed actually uses to benchmark monetary policy. So what we're going to do here is we're going to have a look at what's expected, what it means, how we got here, what's likely, and then consider the most important question of all. Can the markets make hay of it? Will they want to go higher on this data? So let's begin here with the baseline forecasts. The expectations as economists have them envision headline inflation unchanged in December from November's reading, 2.6% in November year on year. We're looking for 2.6% again year on year in December. The core index, which is the one that excludes food and energy, that's the one that arguably is more important because, of course, the Fed can't do a whole lot about directly influencing global food and energy costs. And in any case, as we can see here, goods inflation has been squeezed down next to nothing. The important part of the story continues to be living inside the service sector, and it is the core reading that captures that. On this front, there is a bit of an improvement in the cards. We're looking for a decline to 3% on core PCE, again, year on year. That would be the lowest since May 2021. So more progress, steady progress on what the Fed is trying to get done here seems to be in the cards. Now, looking inside that service sector to see what is powering lingering inflation there, we can see it's still running a bit warm. As of November, we were at 4.1%. That's, of course, down from the peaks that had us north of 5, but nevertheless, still a bit elevated. And the biggest part of that, we can clearly see, continues to be housing. That's that big orange area in the middle. In fact, if we go and break down the components here, we can see that housing contributes 1.7% to November's 3.1% inflation rate. That is, needless to say, a very significant contribution, and suggests that it is here, really, that the last mile of disinflation is. So, with all of that in mind, it's interesting, of course, to consider what it is that we learn about how this piece of it evolves. And to help there, of course, we have, as we mentioned earlier, that CPI release that already came out. Now, of course, these are different baskets. There's a reason why the Fed prefers the PCE to CPI. They're a little bit differently constructed. But it does bear looking to see if perhaps we can glean something from CPI and then take that into the PCE conversation. So here is where we were on CPI for December. So you can see we edged lower on the very important core reading here, although modestly. While the headline notched up a little bit, seemingly as the deflationary part from energy got a little bit small. So the negative readings on energy, though, those yellow bars that you see there on the bottom below zero, they got shallower. And so the headline number, because it was pulled down to less of an extent by energy, it was able to notch up a little bit. But here we can see, as ever, as we just saw with the PCE, the big issue is services excluding food and energy. In fact, when we break down these contributions, we can see that for December's CPI numbers, the service sector saw disinflation, the core saw disinflation. There was a headline rise in overall inflation, but that came from the energy side almost to the tick. 3.3 or 0.33 rather percentage point contribution from energy to a 0.3 percentage point rise in headline CPI month on month. So clearly there's a story to be told here. Now, if we look at what it was in that service sector that continued to power disinflation, we see that, not surprisingly here, it is that housing, in CPI terms, shelter component that is at work. That is by far the biggest contributor to what we are seeing in core services inflation. And when we look at the way that that performed in December's CPI numbers, what is incredibly encouraging here is, of course, the lion's share of disinflation in this most important category for Fed officials came from the shelter component. So it is this very thing, this aspect that is the most potent amplifier of inflation readings in both the PCE and the CPI reports within the most critical sector in both baskets. It is that which seems to have had the most pronounced disinflationary influence in December. This is surely music to Fed officials' ears. Now, what's really interesting here is that it is the Fed's own actions that make housing such a major issue for inflation. It is the Fed's own moves that have, in fact, contributed to inflation by creating this issue with inflation locked in housing. And here's why. Here's the disconnect between the interest rate on outstanding U.S. mortgage debt and where market mortgage rates have gone thanks to the Fed's aggressive rate hike cycle. Now, of course, that rate hike cycle has been successful. There's no question there. Inflation has come down dramatically from the peaks. But a side effect has been the surge in mortgage rates that, of course, discourages both buyers and sellers from entering the housing market. Discourages buyers, of course, because it's expensive to finance. So if you wanted to buy something, it's expensive. But more importantly, even than that, there isn't very much to buy. Inventories are at just 1 million units, which is a multi-decade low, or at least within the hair of one. And so the bigger issue, perhaps even than buyers being priced out, is sellers saying, I have a mortgage incurred somewhere in the 3 to 4% range. We can see, again, the average for outstanding debt that's already incurred, 3.7. So I have a mortgage somewhere over there. If I go and sell a house and then ostensibly need a place to live and so go to buy another one, I am saying that I'm going to take a loan at close to 4% and swap it for a loan that's close to 8. Needless to say, this is not exactly an attractive proposition. And so people don't want to sell. This has been a major reason why we've had very low inventories, sticky housing prices that don't want to come down, and more importantly, in the service sector, housing services inflation. Because since folks aren't going to move, they're going to spend on improvements. They're going to do everything they can to stay where they are, to make that palatable. And of course, the imputed rent component that factors into this conversation and basically says, well, if you can't buy something, you have to rent something. If inventories are low, it's difficult to do either because supply is just very constricted. So is it really any surprise that housing prices aren't falling? And when people are asked to guesstimate how much they would pay to rent their current home, even though they may own it, the estimates are high. Well, it's because supply is high, or supply is low. And so the price is high. So it is the Fed's own rate hike campaign that seems to have ostensibly trapped inflation in the housing market. It is then doubly helpful that without even doing anything yet, the mere fact that the Fed has endorsed market expectations for rate cuts seems to be starting to address this issue. What we have here in the orange is a discounted average for the 30-year mortgage rate. What we've done here is essentially taken what is the orange line and discounted it by the gray line to say, what's the gap for sellers between the mortgage they have and the mortgage they can hope to get? And what we see here is as Fed rate cut expectations start to come into the market, that's that green line there tracking the 12-month forward Fed funds future implied rate. So that's telling you that rates a year from any given point are going to be X. And of course, you can see here they've been declining, shock of shocks, since October, latter part of October, going into November. That was that big build out in Fed rate cut odds. As those cuts enter into the market, the gap between mortgage rates available to be incurred and those already outstanding narrows. So if we were to look at this as a kind of affordability gauge, not for buyers per se, but for sellers, and saying how much more attractive is it for sellers to now sell because the spread between the loan they have and the loan they could get has narrowed, hence the discounting of the average mortgage rate. Well, it would seem it's become meaningfully better, even just as the markets have talked about Fed rate cuts. All of this seems to suggest two things. Number one, progress is being made in the very category that the Fed wants it to be made in. So CPI numbers would suggest that if we get anything analogous in PCE, then what we're looking at is continued gradual disinflation in core services as powered by the disinflation in what is the most important, most outsized remaining component, core services, and even more specifically, housing/shelter. All that surely is a relief. The second thing that we learn is that not only would rate cuts not upend progress toward the Fed's inflation target, if rate cuts allow for more clearing of the mismatch between buyers and sellers in the housing market, by relieving this lockup, thanks to the disparity in mortgage rates, that might actually help disinflation, not hurt it. So rate cuts, in their ability to shake loose the housing market, might actually help the Fed get inflation down. The markets certainly seem to be generally of that view. Again, in the green here is the 12-month Fed policy outlook, and then in the orange and yellow are the priced-in inflation expectations in financial markets. The 2-year is a break-even measure that comes from the bond market. It's a spread between real and nominal bond yields. Real bond yields are, of course, nominal minus expected inflation, so when you take the real and the nominal, and you subtract one from the other, the difference you are left with, the residual, is that inflation adjustment. That's called the break-even rate. That's what we're seeing here. In the orange is a swaps market-based inflation expectation for 1 year. And what we find is that even as the market is pricing in more and more cuts, starting in about late October, early November, and the 12-month outlook comes down from the peak at 5.2%, closer to about 4 now, implying that essentially we're going to get about 1.25 worth of rate cuts over the next year, right around in line with Fed expectations, at least as far as the markets have them. Right as that decline, right as that dovish adjustment is occurring, inflation expectations are falling. As though the market is screaming at Fed officials to say, you can cut. You are not going to undermine progress toward disinflation by cutting. You should cut. We're not going to punish you for it with higher inflation expectations. This thing is not going to get away from you. Go ahead. Now, all of that is surely good news. There's surely something for markets to like there. But the markets have liked this story for quite some time. In fact, the blistering rally that we have seen since late November, just as this whole shift started, this is, of course, exactly what it's been about. Note that from late October, early November, the S&P is screaming higher as more and more rate cuts enter into expectations. The rate cuts are that series of gray bars that you see, that's the spread between January and December Fed funds futures implied rates, which essentially just tells you where the total difference is likely to go. So how much of a change there is likely to be between January and December, and so implies how many rate cuts we're going to get. As you can see, we're now hovering just at about 5 cuts. So 1.25%, 125 basis points. That's a little bit more modest than the 6 cuts that we were expecting toward the turn of the year. That was here. That's 150 basis points, or 1.5%. Now we're closer to here. But any way you slice it, there's been a significant build in the S&P, and it's come thanks to a significant increase in the number of rate cuts that are expected. And so the question now is, okay, we're going to get PCE data. It's going to tell us all of the things that we want to see. It's going to tell us that inflation is slowly cooling. It's going to tell us that it's cooling for the right reasons. In so doing, it is going to set the stage for rate cuts. But who doesn't know this already? The market has priced in 5 of them. So the question really isn't, will the PCE report endorse a dovish Fed? The question is, how dovish? And looking at what the markets are seeing here, 5 seems to be what the markets anticipate. That's how dovish. But of course, what did we see this week? We saw economic data suggesting that the U.S. economy is much chipper than anticipated. The numbers that we saw on PMIs on Thursday, much better than expected. The expectation was that U.S. growth was going to slump, that it was going to slow, that economic activity would grow at the weakest rate in 4 months. Well, that is very much not what ended up being the case. Instead, as you can see here, the composite PMI index rose to 52.3. That would be the highest since June. So we're looking at a much more robust U.S. economy. In fact, even manufacturing, which had been stuck in contraction mode really since late last year, late 2022 even, it's even managed to eke out a bit of growth. And then, of course, there's the fourth quarter GDP report, which echoed that PMI with a much stronger growth rate, 3.3% annualized quarterly growth in U.S. GDP in the fourth quarter, certainly down as widely expected from the 4.9 in the third quarter. That was on everybody's bingo card, but much better than the 2% expected by the markets. So the question is, okay, we're going to get this PCE data. It's going to say all the right things. But is it going to get the rate cut tally any larger? And is there anything in there that is going to be game-changing relative to what is priced into these markets already? And the answer is, well, probably not. Unless we get a PCE number that is wildly softer than expected, it seems unlikely that any more rate cuts enter the forecast on its basis. Unless we get a wild surprise higher, it's unlikely that the markets thoroughly jettison rate cuts altogether. No, by the looks of things, and sizing up these expectations, the PCE report is likely to be slow and steady, gradual disinflation, exactly the kind of thing the Fed wants to see. But of course, that clashes with a need to do 5 rate cuts. And so the response from financial markets may well be of disappointment. Not because the PCE data doesn't show precisely what the Fed wants to see, but because when the Fed makes its policy announcement the following week, that thing that is going to be the object of speculation, bar none, front and center after this PCE report, that Fed isn't going to be inspired to say we should cut more or even endorse a 5-cut cycle, considering its forecast of 3 back in December, following economic data that suggests the U.S. economy is hotter than expected, not the other way around. So the key question for the markets is perhaps less so, does the PCE data justify cuts? That much seems a given. The question is, are the markets out of ammunition to keep the rally going? And when the event risk passes, might liquidation set in because there is just not very much else to price in here? And if anything, while there's likely to be cuts, 5 might be excessive if the Fed were to be taken at face value next week when they opine on this hotter than anticipated U.S. economy. And so the risk here is to get a PCE report that says everything that everybody wants to see, but relative to what's priced into the market, it's too modest, too tame, and doesn't move the needle. And in the absence of that, the proximity of a Fed meeting likely to opine as much, frankly, might well drive liquidation and see stocks finish the week on the back foot. For no other reason other than there is just no immediate fodder to keep the story going. And that is macro money for today. As ever, we are here right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened on Wall Street on a given day and what happens next thereafter. Little programming note, we're shifting to a new schedule next week. Both Overtime and Macro Money will start a half hour earlier, right after Last Call with Tom and Tony. For me, I'll be on that show, of course, both of them as usual. Also on for Futures Power Hour with Chris on Fridays, where I'll be tomorrow as usual as well. On with Tom and Tony for First Call on Sundays. Opining on the platform formerly known as Twitter, and writing for the News and Insights portion of tastylive.com, where this very analysis is already posted in a kind of abridged written form. Thanks very much for joining. Good luck out there. See you tomorrow for Futures Power Hour.